Welcome to Prompt Your Life. I'm Christoph Theodor. And today we are breaking down the critical intelligence and high stakes moves shaping this landscape.
Long-term market indexes map a steady upward trajectory, yet actual retail accounts rarely match that theoretical potential. The discrepancy between theoretical market returns and actual accumulated wealth comes down to a process called structural investment leakage. This underperformance exists independently of market crashes or extreme volatility. Predictable systemic frictions drain the portfolio's growth year after year. This attrition occurs along three primary vectors: the underperformance of active management, the hidden execution costs of trading, and the drag of poor advice. Thanks to empirical market research and 2026 global regulatory data, we no longer have to guess at these impacts. We can measure them exactly. Plugging these three specific, systemic leaks is the single most critical determinant of long-term wealth preservation. To measure the first vector, we look to the SPIVA framework, the institutional scorecard that evaluates actively managed funds against passive benchmarks. Investors pay management fees under the assumption that professional expertise will generate an active management premium, returns that consistently beat the broader market. In 2025, 71% of Euro-denominated global equity funds lagged the S&P World Index over 1 year. Over 10 years, the failure rate climbs to 99.17%. Across the Atlantic, it's identical. 99.48% of U.S. equity funds failed to beat the S&P 500. Active managers are often bound by strict regulatory diversification rules. This forces them to underweight dominant megacap stocks, ensuring they drag behind a simple market cap-weighted index. The active management premium functions as a net cost. The mathematical probability of a manager overcoming their own ongoing fees over a decade is statistically negligible. The second vector of leakage occurs at the point of execution, built into the illusion of free retail trading. Under payment for order flow, or PFOF, brokers offer zero-commission trades by routing orders to market makers, who then kick back a rebate to the broker. Without a direct commission, the cost is embedded in the transaction itself, through a slightly worse execution price hidden within the bid-ask spread. Regulators have recognized this drag. As of June 30, 2026, the European Union's revised MyFair framework bans payment for order flow entirely across the bloc. Stripped of spread rebates, European neobrokers are shifting to internal matching engines and monthly subscription tiers. Shifting from spread capture to flat monthly subscription fees alters the underlying math for investors making small, recurring contributions. Execution friction is inescapable. Whether hidden in the microscopic fractions of a penny via PFOF or charged directly through a subscription, these fixed marginal costs apply a disproportionate drag to small, passive portfolios. To see why these basis points matter, we have to look at compounding decay. Just as interest snowballs over decades, so do structural frictions. This SEC chart shows the impact of a 1% fee over 20 years. Green net returns are compressed by blue fee zones. You lose the fee and the returns it would have generated, costing $28,000 on a $100,000 portfolio. We can visualize this decay by tracking 3 different investor paths over a 25-year horizon. Each starts with $10,000 and experiences a baseline 7% gross annual market return. Scenario 1. A self-directed investor paying 0.1% grows their capital to $53,000. Scenario 2. A bank-led investor paying 1.5% ends with $37,000. Scenario 3. A social media follower, dragged down by fees and bad advice, finishes under $27,000. These final balances reveal the cumulative cost of suboptimal portfolio structuring and expensive advice. That third scenario highlights our final vector of investment leakage, behavioral drag, driven by unregulated digital actors and financial influencers. While active funds and execution spreads drain wealth slowly in basis points, emotional trading and fraudulent advice destroy principal rapidly. The scale of this issue prompted 2026 warnings from global regulators, including Germany's Federal Financial Supervisory Authority, BaFin, targeting digital return fraud. Regulators flagged specific digital tactics, websites promising guaranteed returns, unauthorized offshore credit platforms, and identity misuse operating through messaging apps. Consumer protection data reveals that only 28% of social media financial influencers hold relevant professional credentials. Yet these influencers post more frequently and generate higher engagement than actual credentialed professionals. The damage is quantifiable. Investors who follow the advice of unskilled influencers record an average loss of 2.3% relative to market benchmarks. This investor gap functions as a behavioral tax, penalizing those who abandon passive structures in the search for shortcuts. A portfolio's ultimate net value is strictly dictated by the friction it encounters over time. The 99% long-term failure rate of active global equity managers proves that skill rarely overcomes the drag of management fees. Zero-commission brokers extract their toll, whether invisibly through execution spreads or transparently by shifting the burden to subscription tiers. And the finfluencer economy introduces a behavioral gap that compounds these mechanical losses. The impact of this leakage often remains unnoticed until the decumulation phase of retirement, when an investor realizes their final balance is 20 to 30% smaller than the baseline market performance. Maximum wealth preservation requires passive market structures and a rigorous skepticism toward any entity promising to outperform the mechanics of compounding.
Disclaimer: the content on this channel is for informational and entertainment purposes only. I am presenting my personal investments and strategies here as part of Prompt Your Life. This does not constitute investment advice, a recommendation to buy, or financial analysis. Investments in the capital market are associated with risks. Always act at your own risk and responsibility.